compared to interest rate. Reason being, these are more fluctuating compared to the interest rates, right? So before we start this chapter, we'll just see some of the terminologies. However, if you just look from the exam perspective, mostly they will just ask you the mitigation of this. They won't go into detail of that. Okay, so simultaneously we'll try to learn some of the mitigation techniques. We'll discuss some risk and some mitigation. Though we don't have direct currency risk now, but obviously when we go for a new market or go into international operation, it might come in. Okay. Exchange rates. What are the exchange rates? It is expressed in terms of quantity of one currency compared to other currency. Like we have from UK pound to US dollars is the best example. We can do Indian rupee to pounds, same thing. Spot rate is the current rate, or we can say within 2 working days. Next is inverting exchange rate. So we can just, instead of saying the amount in GBP, we can say amount in USD, or instead of saying in USD, we can say in roundland dollar, one and the same. Next is spread. This is mostly useful for the bank. For example, when we put money into the bank, obviously, if you are, let's say, translating the currency, so bank might take a higher rate and give us a lower rate. Why? Because they want to get the profit. They have some small fraction of margin in that. That is known as the spread. Commission fees and everything. Then we have cross rates. Instead of doing directly from GBP to US dollar or to our dollar in roundland, we can do cross rate. Let's say we know from GBP to USD and we know from USD to roundland dollar. Now we can get roundland dollar to GBP. It's mostly useful for the calculation purpose. Very basic terminologies. Now, when we talk about risk management, okay, so one of the way is to speculate how things will be in the future, because it's a very big risk, especially if you think about the bank or the companies who are totally dependent on import and export. Small fraction of change also might cost them a lot. So before going in how to predict, obviously when you talk about prediction or forecasting, nothing is accurate, but we just get some idea about it. So firstly, we'll understand why it fluctuate. One of the reason is speculation. Speculators enter into foreign exchange transaction with a view to making a profit from their expectation. You must have been heard a lot of people invest in this currency fluctuations also. They'll see some currencies going up, going down. They just sell the currency. So ultimately it will affect the demand, which can also lead to, no guarantee, but it can also lead to. Second is balance of payments. Since currencies are required to finance international trade, changes in trade may lead to changes in exchange rates. For example, now more than 80-85% of the world trade is in US dollars. But now China wants to come up with their own currency for international. They want to push their yen, right? A lot of geopolitical things. Imagine if these things goes forward, definitely the value of the US dollar will go down. That is balance of payments. Now everybody is using US dollars, so definitely their currency is more stable and more in demand. Next is government policy. Government may wish to change the value of their currency. This can be achieved directly by devaluation. Best example is Japan. Japan is such a strong economy, but still their currency is very low. Yes, Vishal.
Sorry, Ms. I don't want to interrupt your flow, but correlating this subject, this topic with our case study, do you think that we will have some implications, because we're currently in roundland in our dollar, even if we are talking about investment in a new market? So it's like basically, I would say, entering into new market where the currency is different. Then obviously the proposal will be assessed independently in advance whether the currency is fluctuating or is it actually stable currency. So in that perspective, why do we even have to face this situation when we'll have enough time to rethink about the proposal, which we'll anyways do, isn't it?
Yes, that's a good question. So there are two answers to that. First answer is, imagine we are just doing business like we are doing now. Imagine we didn't go to new market also. Okay. Still, we have some players who are international. Like we have an automobile company, we have one retail companies, right? There may be other companies also who are doing exports to imports to Roundland, isn't it? Maybe there are some companies who are giving us business only because we are expecting their currency, or we are expecting, we are accepting US dollars. Or if we are not accepting, maybe our competitors are accepting.
Mm-hmm.
So because of that, we need to know how is this currency risk for us. Because yesterday we discussed one point. If you are not taking, if you are a national level company also, but there may be companies who are international, they can get benefit from the changes in currency rates. Plus, we have clients which are international, so definitely they want to push us for us to go to US dollars or maybe their own currency. Otherwise, they might not give us business. So definitely, we have to understand that
Okay. Okay.
we
So
are.
you mean our key clients can be or could be operating in a different currency than our dollar, operating out of a different place. Not necessarily we are, but our clients will be. And
Yes.
their base currency would be, for example, dollars or pounds or something like that. And
Yes.
then the
The best
currency risk exposure will be ours because we are in a different currency. You are saying this.
Yes, that is the
Okay.
first point. Now coming to second point, you said when you go into new market, the first question will be obviously what are the, is it feasible, SAF model we can use and other areas. This will be something coming at the end, right? However, if you see CIMA's some of the past papers, what they do is usually it's three section and all three sections are interconnected. Some of
Yeah.
the exams what they have done is, let's say now we are going from Roundland to Eastland. That's the first section, and they will say, shall we go to the Eastland, and subsection maybe let's acquire a company ABC there. Okay, now when we go to second section, they'll be like, we want to practice risk, integrate in everything what we do. So what will be the major risk of going there and how we can mitigate that. So when you go international market, major risk will be currency fluctuation. You can talk about that risk and that mitigation. So within one question itself, all these things are tested and can be tested.
Okay. Okay. So dwelling on this more, if I am actually acquiring a new firm operating in a different currency,
Right.
right? And obviously it's a good deal, but at that moment I will not be just so fussy about whether this currency is strong or not. If I'm getting a good deal, I'll actually going to invest it and I'll going to acquire that firm. Now, in this case, you're saying that it could be a possibility that even if you are not dealing with a new customer or an existing customer in a different currency, but it could be a good proposal where you are entering into a new market through that company acquisition, then probably your risk exposure to be assessed in advance, isn't it?
Yes, because
Hmm.
we have to do risk management in advance.
Okay, got it. Clear. Thank you.
You're welcome. This
Just to
question
add
can
one
come.
point here,
Yes, sir.
like Misbah said, there could be a scenario. I mean, I was reading one question yesterday. So mostly these operational things are a part of scenario planning in most of the questions. So they will give you one event that is going to happen, and then we need to list out the scenarios there. So in that scenario, they ask us these things like, what are the risks there? So you need to give the scenario like that.
Right. Sometimes they might ask directly about currency risk, the entire section, or sometimes it can be part of all major risk. They might ask you what are the major risk and how we should mitigate that. So in that, for example, we are reading this. So you can say one of the way of mitigating currency risk is understanding why the rates fluctuate. And there are certain formulas also. We don't need to know the formulas, but certain theories like purchasing power parity theory, interest rate parity theory, international Fisher effect. For example, interest rate parity theory will say when interest rate change in the same proportion, the currency rate will change. For example, interest rate is higher in US and lower in UK. So the value of the UK currency will be more stable than the US currency. Because of the interest rate, the value of their currency will come down. The higher the interest rate, the value of the currency will be less compared to other countries. Does this example make sense? We
Yes,
don't need to
yes,
do
to
the
me.
calculation. We can give this as a mitigation. We can use certain forecasting exchange rate theories to mitigate that. This can be your
And
answer.
this, and I'm sorry for I'm just going before you. 1 10 seconds thought is, it's always good to forecast, like you said, Misbah, that sometimes hedging is not also quite an easy option to go with when you are actually talking about the investment per se. It could be quite costly. So forecasting would be anytime better than hedging, isn't it?
Yes. Hedging, or you can just ask them if it is only one customer or one client, we can ask them, request them to pay in round and dollar.
Mm-hmm.
If they're giving a good service, they might accept it.
Hedging actually works in a way when you have a big volume, then only it is beneficial, not for a smaller thing.
Thank you. Over to you, Farah.
Sorry, don't worry. Sorry, Miss, but can you I didn't understand it, so could you explain it again?
Explain this theories.
Yeah, because I didn't follow.
Yes, I'll come to that.
Okay,
I've not
sorry.
come. I was just giving an idea. We'll come step by step.
I see you explained. I'm thinking I didn't understand. Okay, sorry.
No problem. I'll come to that. Sorry for that. I just giving answer to Vishal, so I just jumped directly there. Okay, I'll come to that. Come to that point. We are discussing why we need to do this chapter, why we need to read this section. Okay, so I hope it's clear now. So why exchange rate fluctuates? Government policy can affect capital movements between economies, import, export, inflation rates, interest rate, everything will affect the currency rates. Arbitrage, again, some people will deal in this, not very relevant to us. Anyways, now coming to the theories, forecasting exchange rate. So Farah, as a business, imagine tomorrow DAISTRUK is going more into import export, and we are dealing in different currency because we don't want to leave any clients. So definitely, like we talk about hedging and all, we can use that, but it can be very expensive. So one of the way to forecast the exchange rate is to use certain theories. So there are some big theories like purchase power parity theory, also known as PPPT. Then we have interest rate parity theory and international Fisher effects. So all this is coming to same objectives. It can give you some rough idea what will be the exchange rate in the future. Based on that, you can decide how much to hedge or not, and whatever your personal strategy or your business personal strategy for the currency risk management. Okay.
Yeah.
For example, what is PPPT? They won't ask this. They're just going through it quickly. Law of one price. So it says that if, let's say, if we buy Apple in UK or we buy some Apple in US, it should be technically same. It's very basic example, but something else. Let's say some cars or anything else. It should be probably the same price. If this is not the case, then arbitrage will take place until a single price is charged. Arbitrage is something like what people do. Imagine something is very cheap in some country. They'll take it from there and sell it another country at very higher price. And they make profit. Therefore, government will come in then government will put tariffs on that, other indirect taxes on customs, just to maintain the local businesses. However, it's very difficult to have same goods price in a very radically different rate in different countries. There's one formula also. Hello?
Yeah.
Yeah. Then rule is the country with the higher inflation will suffer a fall in depreciation in their currency. So basically, if we have higher interest rates, what will happen to our currency? It will go down, isn't it? Because if the interest rate is higher, the inflation is higher, the interest rate will be higher than the inflation. Ultimately, things will become expensive. Let's say we buy one apple at $1 in US, and in UK it was, let's say, £1. But after some time, the same thing became $2. So what will happen? $2 in US and £1 in UK. So what you will say? The value of US dollar is less than UK pound.
Yeah.
Isn't it? Things are expensive means what? The value of the currency is low. Nowadays, a lot of currencies are going through that issue. So people are holding in international currencies. Make sense?
Yeah, thank you.
So just to do the calculation, we can do interest plus what is our FAR currency, then divide by interest plus our home currency. Okay. Other areas affecting this are cost of physically moving products from one place to another, different taxation regimes. We are not considering this. We are just looking at in a normal way. Then arbitrage. If there is so much of tax, then manufacturing, direct, indirect taxes, and other rules, then it will be a different thing. Next is IRPT. This claims that the difference between the spot and forward exchange rate is equal to the differential between interest rate. Whatever the interest rate, based on that, the currency's future rate should be. Same thing, predicts that the country with a higher interest rate will see forward rate for its country currency to go down. But obviously we cannot depend 100% on that, because government intervention, if government want to keep their currency high, they can do that. Government want to reduce their currency value, they can do that. But imagine government is not intervening, everything is normal, happening naturally, then definitely it should be according to the interest rate. Again, it will give some close idea to us. Then third one is international Fisher effect. It claims that the interest rate differentials between two countries provide an unbiased predictor of future exchange in the spot rate of exchange. Whatever the difference is, the interest, it's very close to this only. Just looking at what is the difference, how this interest rate is changing and how their interest rate is changing. They also talk about some real interest rate. Real interest rate is something like, for example, if you have inflation of 5%, right? So 5% is anyways banks have to charge. Let's say bank is charging 7%. So real interest is how much? Only 2%. Why? Because 5% value of the currency is anyways going down. So these people will consider only 2% as the real interest rate, because that's the actual interest we are paying, because 5% is anyways the inflation. If you want, there are questions also, but not required for us for the question. Any confusion here?
No.
I think I understand.
You just have to remember for your case study exam is that forecasting exchange rate is also a mitigation for us. Simple as that. You can give one of this example, just like IRPT. That's it. Nothing more or less required. And before going on that, first we have to find the process, like what are the risk exposures we have. Like currently our exposure is definitely low. We cannot say we don't have any exposure. Even small businesses have this exposure, right? For example, we'll go to other industry, let's say retail market. Somebody is manufacturing in Roundland and selling it there. But imagine its competitor, let's say the first company is A, now the competitor is B. The B is importing same things from China and selling at 50% price, because he's getting it for very low price and he's passing on to customer. Though A is not involved in any of this, but B is giving it competitive advantage. Why? Because B is importing from another country. So indirectly, every business is getting affected by this. Then decide whether or not to hedge, implement and monitor hedging. Basically, the simple meaning of hedging is just to manage financial risk. In hedging, we have a lot of options. I remember in one of the exams they have asked, give financial risk management technique other than hedging techniques. Other than hedging techniques, maybe the one we discussed, forecasting, billing in our own currency, or going into some stable currency. Hedging can involve the reduction or elimination of financial risk by passing that risk on to someone else. Firstly, we'll try to eliminate, but elimination is mostly not possible, so we'll reduce it. Even when we eliminate, we have to spend, we have to pay, it's quite expensive. And as we just discussed, it can be very costly for the companies who are not dealing too much into the currency for international. What are the advantages for that? This is good for you to remember. First is it can provide certainty of cash flows, which will assist in the budgeting process. Let's say we go for hedging. Maybe it's little costly, but at the same time, it will give us certainty. It will help us to plan our cash flows. It will help us to assess the risk. It will help us to do the budgeting, forecasting, lot of advantage, isn't it? Then risk will be reduced, and hence management may be more inclined to undertake investment projects. More trust in the management. In fact, not only the management, but the other stakeholders as well. Then reduction in the probability of financial collapse. Again, reducing the probability. Let's say a company have more or majority of the transaction in international currency, and they have not done hedging. So what will happen? There may be a collapse, a financial collapse also. Probability is very low, but impact can be very high. Managers are often risk averse since their job is at risk. As a business, companies might take risk, but individual managers are often risk averse. If a company has a policy of hedging, it may be perceived as more attractive employer to risk averse managers, because people don't want to put that personal risk on the company's policies. What else can be the pros? There are so many. Can you think of one or two? What else can be the benefit for us? Yeah, Farah, you can start.
I guess it's very similar to budgeting, but we hedge, and the biggest reason we hedge is because it affects our margin. The moment there's fluctuation in the market, our margin gets hit. In a competitive industry, it's very important to be able to stay competitive, that we have sight of our purchases and the costs of our purchases, but also that we are, we're getting the best rate possible at the cheapest rate, and that's really important for when we initiate sales or discount specific items.
Yes, that's a good point. It will affect our margin, and we cannot just change our market price immediately. Yeah. Anything else? Okay. Let's go to cons. Shareholders have diversified their own portfolio, thus further hedging by the business may harm shareholders' interest. If you do too much of hedging and we are spending money on that, and just like diversification of business, when we diversify our portfolio, we talk about this only. In ENSOF matrix also this point was raised. Maybe we have a lot of shareholders who is part of carry our competitors also, and for DAISTRUK as well. Because what happens, sometimes when we see the industry is growing, so shareholders want to part of the same industry in different companies, because they understand overall the industry is growing means most of the companies here will make money. Right? All right. Then transaction cost associated with hedging can be significant. Transaction cost is usually high, especially in the current situation. It cannot be very much suitable for us. Then lack of expertise within the business, particularly with regards to use of derivative. So hedging is very difficult to manage. We need experts for that, and when we go into derivatives, it can be even tricky for us. So we need a skilled people doing that.
When you say derivatives, what is that referring to?
Derivatives is like investment into different currencies and their fluctuations.
Like playing the market, keeping an eye on the market, and
Yes, keeping on the eye in the market, investing in the market, taking quick decisions, all of that.
yeah, I get you.
Basically, derivative is a very broad concept, but not part of our studies. We can just take it like this.
I agree. So just to give you a bit of a story, if you want to call it that, we import. The majority of our purchases are imported from South Asia. North Asia, Far East. And one of the things we did originally was we spot hedge. We didn't hedge, we just did spot trade. So when the invoice became due, we would pay it on the spot because it was pretty stable. And this was all before Brexit. It was at 1.5. And the moment Brexit hit, the rate, I don't know if you remember, the rate dropped horribly. It went from 1.5 to 1.1. It was horrendous. For someone that we didn't hedge, and all our purchases were pretty much in dollars, it really affected us. So we started hedging. But what I found was when I was doing my investigations, that's where I had to draw a line. I had to explain, I'm not in the business of FX. That's not our core competency. We're here to sell stuff, not play the market. And that was very important for me to explain to the board, because you can get very swept up in the highs and the lows of FX.
A very good point. Yes, you're not into business of that. Plus, you have not been doing that in the past. In fact, you didn't do hedging, right? And you depend on a lot of imports that time.
Yeah, absolutely.
Great. Thanks for the example. Then complexity of accounting with tax issues associated with the use of derivatives or hedging. Again, it's more complex for the accounting and reporting as well. So unless we are getting that much returns, we don't need to do that. But imagine a company who is totally into that, definitely for them it is must requirement. Otherwise, no stakeholder will trust them. Simple as that. Next is treasury function. The treasury function exists in every business. Though in small business, it may be absorbed into accounting or company secretarial work. Usually big companies like DAISTRUK, they will have their own. They'll have a separate department, and sometimes it can be centrally run or sometimes it can be separate. We'll just see. Okay, so what they usually work: managing relationship with the banks, working capital and liquidity management, long-term funding management, currency management. So mostly dealing with issues related to money, how to arrange it, how to manage it, all of that. We have some options.
Sorry, before we move on, do you think that's examinable? I mean, was the tendency for us to be examined on that or tested on that?
On
Treasury,
this
treasury management. Yeah.
No. Yeah. So I just want to repeat, they won't test you 99% or 99.9, I can say, on a specific topic. Usually this will be tested as a part of currency risk management. That's it. For example, they might ask you that is it advantageous for us to have a treasury function centralized, or we can do it separately. You can say some of the advantages of that. That's it. Or they can just say what are the advantages or how to manage currency risk, not advantages, how to manage currency risk. So you can say having effective treasury function is also a way of managing it separately, rather than the accounting team is doing it on their own.
All right.
Yes. Reason I'm telling you why they will not test is because these things are tested in, specifically when you give individual OT papers, objective type papers. So it doesn't make sense for CIMA to test the same thing again and again. And obviously in case study, we are trying to reflect real world, and each question will have some skills tested from E3, P3, F3, industry, real world. It will be very complex. So they cannot just come on a specific topic. The probability is very, very low. Therefore, a lot of people don't even, not a lot of people, but there are some people I know personally, they have not touched this textbook also. Still, they have cleared it very easily, SCS exam, because they have practical experience and they were very logical with their answers. But we are doing this because it will help us to give better answers. We don't want to leave anything.
Great.
Yeah. So don't worry. Don't remember anything. I mean, just understand it. Any logical point for this should be fine. Okay. Now, how we can manage it internally? Best thing we are discussing already is invoice in home currency. We discussed the example of CIMA, ACCA, and other companies. We can do that. Second is leading and lagging. If we feel like the current situation is not very suitable for the transfer, we can ask the party to wait for a certain time to make the payment, or sometime we can ask them in advance if we are assuming things might go bad. For example, when Brexit was about to happen, maybe for us, company would have asked them to pay the payments early, or lagging would have been very difficult because it took very long. But if it's possible, we can do this leading and lagging. This will only come if you have proper forecast and you have proper experts who are able to guide us on that. Matching.
Even the experts can't tell you nowadays.
Pardon me?
I said even the experts can't tell you nowadays.
Yeah, nowadays obviously a lot of things are
Mhm.
it's very complex. Yes, but at least if you have some idea, maybe we can do that.
Yeah.
Next is matching. The technique involves matching assets and liabilities in the same currency. Assets and liabilities is just like your payments and receipts in the same currency. You'll just pay from your receipts there. Simple as that. You don't have much of the effect on your final results. Therefore, companies go for the foreign currency loan. If you are starting something in East Land tomorrow, DAISTRUK will be happy, or any company would be happy to raise money from the local banks, because currency risk then and there itself is reduced to the minimum. Then we have netting. Netting normally involves the use of foreign currency bank's account. If a company knows it will be both receiving and paying in foreign currency, it can reduce exchange risks. For example, we are operating in 3 to 4 currencies. Rather than having hundreds of or thousands of transactions, we can just do the minimum number of transactions. Let's say A, B, and C is there. A owes B also, A owes C also, then vice versa, they owe each other. So instead of doing all the transaction, at the end of the period, they will see how much A owe to B, how much B owe to C, and in that way, they will reduce the transaction cost. For example, A owes 1 million to B and B owes 2 million. Right? So they'll just cut 1 million and B will pay 1 million. That's it. So there is no transaction when A is paying to B. Just very basic example I'm giving. You don't need to explain how it works in your exam. You just have to say netting can be a good way. Will reduce the transaction. You should know some characteristics of that. Okay. Usually this question will come for 30-40% or 20-30%. So you can just mention 1 point for 10%, something like that. It should be fine. No need to mention everything if it is only for 30%. You won't have time, plus it's not worth it. So your answer should be very smart. We'll do one session on that as well. Okay, how to construct the answer and everything. Next is pooling. Pooling is a system of managing cash. When a business has several bank accounts in the same currency, it may be able to arrange a statement with its bank. So they can do everything together at the end and see what are the receipts and payment. That way they can pool it. Last one is counter trade. It's very similar to barter system when we don't have currency in existence. This involves parties exchanging goods and services for equivalent value, just to avoid the types of currency. But again, the tax authorities and government will not like it, because there is no tax coming in, there is no proper record of the goods moving and all of that. Might be unethical also. So if you go with internal, we won't have much cost. Internal hedging, or we can say international financial risk management, the cost will be less. Another option is external. Netting center can work internally also, internally also and externally also. Externally, we can go to big companies who can help us with that. But ultimately, the way of working and everything is same. Then we can go with the contracts, currency forward contracts, buying and selling at specific date. For example, we know after 6 months on this day, we'll be receiving this much money. We'll just fix that money. Now we are not taking any risk if the currency goes up, currency goes down, any of that. That is currency forward contract. Obviously, these things are not for free. We have to pay a premium for that. We have to pay some fees for that. Money market hedges are again very similar. Only thing is, this is more of wholesale. When you go into contracts, it's very bespoke. But here, when you go to money market hedge, it's kind of wholesale. We have less control to make it bespoke for us. Which one is good? It all depends on which way or what kind of business the company is doing. They're talking about process and all, not very important for us. I don't want to confuse you with it. Then currency futures, again, another type of contract. Futures or derivative contracts such can be traded on future exchange, which guarantees the price. Ultimately, it's all about managing the downside risk. We are not looking at upside here. We are just wanting to avoid the downside risk. Takes and basic point is something. We have one last thing, that is options. Options is something which can give us upside. Upside means benefit. Therefore, it is called an options because it's not an obligation. Here, if currency is moving in our favor, we'll not exercise the right. But if it goes against our, then we can exercise the right. If we talk about Farah's example, in that situation, the UK pound went down too much. So 1.5 USD it was, right? It came to 1.1. That time they would have exercised the right to protect against the adverse movement. But imagine it would have gone another way. Then definitely they would have not exercised it. Instead of 1.5, if it would have become £2, they would be very happy because they'll get more cash inflow. However, because of this, we have to pay extra money. This is generally more costly than the other hedging instruments, because here you are not only limiting the downside, but also helping us to get the upside of it. If you want to understand more in detail, I can send you some videos. You can have a look at it, how it works, the calculation, and a lot of real world examples. Okay.
Okay.
Because this is all calculations for the individual, therefore we are not doing that. Black-Scholes model not required. Swap is also a very famous, maybe you have heard of it. A currency swap allows a company to swap currency it currently hold for a different currency for a fixed period. Instead of taking or doing anything, we can just swap the currency. You can do with our own company if you have a head office there, or we can do with another currency, or sometimes we can do with the banks or other financial institution, just to mitigate the movement in currency. Then again you can swap it back at the end of the period. This swap is also used by interest rate. In the next chapter we'll see. We can again swap back the interest rate. Let's say now we are in Roundland, and when we go to a new country in Eastland, we are raising money from there, but they are charging higher interest rate to us. So we can help another company in Roundland to raise the money, and another company can help us in Eastland by swapping the interest rates. And same thing work in swapping the currency. So in a summary, you just remember what are internal hedging techniques we have and what are external, and some of the characteristics of it. That itself is enough from this chapter. Okay. Like internal is very easy. Same thing, you just remember external hedging techniques. That's it. Don't remember all also is fine. Just 3-4 is enough. Any questions?
No.
Okay. Now interest rate risk management. This risk is there obviously for us currently. Yeah, before starting, same we'll see on some terms. Lending and depositing rates. A bank will quote two interest rate to customers, a lending rate and depositing rate. So when I'm depositing, let's say we are depositing from on behalf of DAISTRUK, we'll get less interest. And when they are lending us, then we have to pay higher interest. Why? Because they want to make profit. Simple as that. Then we have LIBOR. This is the rate at which a major bank can borrow wholesale short-term funds from another bank in the London money markets. So LIBOR is very important, especially when we are doing fluctuating rates. We'll see. So if LIBOR change, that rate can also change. Then we have limit. Again, this is mostly for interbank, not related to us. Term structure of interest rate. What does it mean? Provide an implicit forecast that is not guaranteed to correct in most of the accurate forecast. So it will give some idea how we can structure the interest rate and like that. Then we have yield curve. The term structure of interest rate is the relationship between interest rate or bond yields in different terms or maturities. Yield is what? Yield is the return we'll get on it. How much return we'll get. If you put money in fixed deposit, how much we'll get. If you do in bond, what will be the return, like that. So basically, if the yield is higher, then the interest rate can also higher. They are just trying to make us understand there is a relationship between the both. Again, not directly relevant to us, just for the understanding. Okay, what is relevant is this. Same thing, internal and external hedging is important for us. Smoothing, very similar to the currency. The company tries to maintain certain balance between its fixed and floating rate. Yesterday we are discussing, is fixed good or floating good? Again, both can be good depending on the industry, the economy, and a lot of other things or other areas of business. Okay, generally companies try to put a balance of that, fixed and floating. The portfolio of fixed and floating rate debts thus provide a natural hedge against the changes in interest rate. Usually interest rates are not that much fluctuating like currency rate. The risk is less, but movement risk is less, but the amount involved here is very big. Once we get locked up into a fixed rate, okay, and for a very long term period, imagine if even if it is just 0.25%, it can cost us a lot. Then matching, the company match its asset and liabilities to have a common interest rate. Again, your loan and investment we can do in such a way, so we'll get to reduce it. Next is netting. The company aggregates all position, both assets and liabilities, to determine its net exposure. Net risk, net exposure as in ultimately how much interest we are paying or how much we are getting. Mostly it will be payout for a parent group. If you go to external, we have first is forward rate agreement. We'll just agree with the bank on the forward. Let's say we need a loan at the end of 2023. So DAISTRUK can still go and do a forward rate agreement with the bank. This generally companies will do if they assume, like currently is the best situation to say that. Now we have war going on, then geopolitical issues are there, then COVID is still is settled, but still there is a lot of things sometimes comes up. So if you feel like in your business, maybe by the end of the year, the interest rate can go up. And obviously you want to do that deal. And you or other stakeholders are very confident. So what you will do, you'll go, and the board of the DAISTRUK will go and say, we need loan at the end of this year. Just give us the agreed interest rate. Most of the time that interest rate will not be the same as today, because bank themselves would have done some forecastation for the interest rate, and they'll come up with certain numbers. If you agree with that, you'll agree it. And we don't know after 6 months, when we reach to the year end, 6-7 months, whatever the rate is, it doesn't matter, because we are going into agreement now. Okay. About the rate of interest on a national amount of principal starting at the future date. It's just we are fixing the future interest rate now. This much is enough for us to understand. And they have given how it works and how they write it. F-8 means 5 to 8 months. Anyways, you don't need to know that. Okay, settlement, when we are settling it. If the fixed rate in the agreement is higher than the reference rate, that is LIBOR, the buyer of the FRA makes a cash payment to the seller. Again, not directly important, but if LIBOR rate changes, it goes up than the agreed, then obviously it's a loss for them. So you have to pay the seller, like that. Anyways, don't worry about it. Next is interest rate guarantees. Very similar to that, external hedging. Interest rate guarantees are options on FRAs, so the treasurer has the choice whether to exercise or not. So here the difference is, again, it becomes an option, but previously it's an obligation because you are going into a contract. Here you'll use it. Okay, same example. Now at the end of the year, now in December, DAISTRUK needs money. Okay, now we have an option. Whatever we have agreed, if the price is same, then it's good, you'll go for it. But imagine what you are expected, that thing has not turned up, so you'll not exercise it. Basically, company will use whatever is favorable for them. They are over-the-counter instrument, works with bank and have maximum maturity for 1 year. Call and buy option. Anyways, then we have interest rate futures or IRFs. IRFs are similar in principle to forward rate agreement, the first one, in that they give a commitment to the interest rate for a set period. They are tradable contracts and operate for a set, but usually these are for small periods, 3 months. Like let's say they are starting in January, then March, June, September, December, like that. Now they have given some characteristics, how they have written. Usually they won't ask, for example, if they write 95, that means it's 5% interest. If they write 97, it will be 3% interest. Then we have exchange rate, traded rate options. Again, this is in options, the similar to the previous one. If it is going for our benefit, companies will use it. Otherwise, we don't need to go for it. The last one is swap, what we discussed in the last chapter, similar to that one. I'll just read again how it works. An interest rate swap is an agreement whereby two parties agree to swap a floating stream of interest rate for a fixed stream of interest. There are two types of swap. One is we are just swapping the interest rate. Second swap with the bank is via bank, we can say fixed to floating, floating to fixed. Let's say we have already taken fixed. Now we are assuming that things will change. The interest rate can go down. So we can move to floating. And another party, if they thinks like we have taken floating and the LIBOR is going up, interest rate will go up. They want to go something more stable. So they can go from floating to fixed. Obviously, you cannot exchange the principal money. You can only exchange the interest. Because obviously their principal and this principal will be totally different. And this is best for the long-term borrowing. Why? Other ones, if you are seen, they are talking about up to 1 year and all. But these are mostly for the long term, from 1 year to 30 years. Banks act as a swap counterparty. Whatever we do, we have to go through bank or financial institutions, and they always make money. They have their charges, whatever benefit or loss the companies are getting. Banks are one of those who are always making money with taking the lowest of risk. Am I right, Emmanuel? You want to add something about banks here, as you are a student of that, studying
Um,
that?
I'm sorry. I mean, I got divided attention. I was doing something else. What did you say? Sorry.
I said whatever we do, swaps or internal external hedging, bank always make profit despite being risk averse.
Oh yes, I mean if the bank is not making a profit, then obviously its existence is questioned, because they're making sure that you deposit, and then the money, the net, I mean, the difference between the deposits and then what you borrow from them is in their favor. So banks will always make sure the balance is in their favor. I don't know if that makes sense. Yeah.
Yes, and obviously they get a lot of transaction charges also. So usually
Absolutely.
they make very high profits compared to other industries.
Yeah, there are banks actually. There are some banks that are also making losses, like the Silicon Valley situation, just because of non-performing loans as well. But that's, I think, it could be discussed as a matter of corporate governance and strategic decisions. But ultimately, yes, I mean, the physical transactions that they make should actually bring them profit. That's what they live for.
Yes. Calculation, I'm just ignoring here. Yeah, that's it on that. So you just remember internal external hedging for both currency and interest rate risk. That should be fine. We'll do one question also on that, so you'll get more confidence. Any confusion now? Any questions on that? Or shall we move to next?
think that with this currency risk, personally I think I need to visit it and then make sure I understand it really well, because it's not something I'm really familiar with. I've heard some of the terms, but I mean, just to make sure that I am really competent and be able to answer questions on that, I think that I would have to look at it again personally.
All
Yeah.
Okay. If you have anything, we can discuss that again.
All right. Thank you.
Others, any questions?
I'm with the manual. I'm going to have to read it over again just to make sure that I make notes and understand my 2 or 3 points for internal and external. The FX I do get a little bit more because I do it at work. It's the interest rates that I might need to review.
All right. Okay. I'll see if I get any videos also. I'll share with you.
Yeah, that would be great.
Don't go much into calculation. You can if you have time, but not very much required for the examination.
Okay.
Yes, even I feel like reading through the textbook is always good. We should do that because this topic of call and put and everything is not so regular for us. But then apart from that, if we can just solve some examples or the exam questions, would be great. Will give us some more idea what exactly we need to write in the exam and what will be the context.
I'll share one question with you.
Yeah.
All right. So moving on, the next chapter. Okay. Ginny, are you there?
Yeah, Ms. Bar. Even for me, I feel like I have to go through this.
Okay. Yeah. So moving on to next is, somebody was saying something. Okay. Next is financial and strategic implications of mergers and acquisition. Merger and acquisition we have discussed in E3 also, and P3 also we touched a little bit about the risk of it. Now we'll see how it will affect us financially. Okay. So before going that, they have just given the explanation again, the basic explanation. What is merger? What are the types of merger? We'll just quickly go through it. Maybe you guys are already aware of it. Types of mergers and acquisition. Firstly, the difference between mergers and acquisition is, if tomorrow DAISTRUK acquired, let's say Carry, so it will become DAISTRUK only. But if they both merge, then it can become DNC, DAISTRUK and Carry, or they might come up with a new brand name. Okay, but most of the financial implications are very similar for that. So in the textbook, they have given M&A together. However, they are a little bit different. Okay, so mergers and acquisition can be horizontal. Horizontal means at R level. For example, now Carry and DAISTRUK, or DAISTRUK and DHL. These are all horizontal at R level. Vertical is divided into two. That is forward and backward. Backward means our suppliers. For example, if we acquire, somebody is providing us oil, somebody is providing us other services, that will be vertical backward. Now vertical forward will be a little difficult here for us because we are doing directly to the companies. Maybe vertical forward for DAISTRUK can be acquiring this retail company. We have one retail company. What's their name? Murdoch's, right? Or acquiring any other of our client can be vertical forward. Then we have a conglomerate. Conglomerate types of mergers and acquisition means going into the unrated business or sometimes rated business, but outside the current scope of us. For example, we acquired a passenger things. Yesterday we talked about passenger vehicles company. That will be a conglomerate. Related. Mostly conglomerate is type of unrated diversification going into the new industry altogether. Let's say tomorrow we went into manufacturing of automobiles. That will be a conglomerate for DAISTRUK. Okay. Now we'll just go a little bit step in detail here. What kind of mergers and acquisition do you think will be suitable for DAISTRUK? Okay, before going to that, we can just see the reasons for that, because 100% one of the questions should come from here, because every exam they'll ask questions from here only. It's good if we predict that, then we see the risk of it and the financial implications. Okay, what are the reasons or advantage and disadvantages of this? It will increase the market share. If you go for horizontal, it will increase more actually. It can give us economies of scale when it is related. It will be giving us more complementary needs. Again, it's more relevant when it is horizontal. It will improve efficiency of work. You'll get good talented people. A lack of profitable investment opportunities. You might get more opportunities now. Tax relief. Tax relief can happen. Imagine one company was making loss and you acquired it. So the overall tax will go down. This is also one of the reason why people want to acquire another company, just to reduce their taxes. Reduce competition. Now your immediate competitor or another competitor is your own team now. You have become one. So reduce competition. Even this can help in vertical also, horizontal also. Asset stripping. Let's say they have a lot of warehouses. They have maybe intangible assets as well. Some licenses and all patents that can also help. Big data opportunities. Nowadays, companies are acquiring other companies only for big data. Last exam, I have one student. They were working in marketing company. It's a listed company, very big. So they said they acquire around 20 to 30 companies in the last year, and only reason was to get the big data. It depends which industry we are. Now big data is important across the industries. Okay. So the question here is, we'll discuss now about what type of merger or acquisition is useful for DAISTRUK now, and obviously why. What reasons you think will help us from here, or maybe another reasons also we can add. We can even link this to ends of matrix also.
I think when we go for a vertical what vertical integration, right? Is that a word?
Yes, vertical integration.
Yes.
Vertical backward is also there. Vertical forward is also there.
Okay. So vertical integration, as in when we acquire, have opportunity of acquiring the supermarkets like Maddox, so we can actually manage the flow of goods and services, so that we wouldn't have to actually agree with a Maddox management in order for us to distribute or to manage our warehouses really well. It will give us the freedom to make quick decisions and to make sure that business runs smoothly without not actually consulting anybody, and that will also make sure that our resources are always available, and then it gives us the opportunity to make I'll repeat myself, to make decisions without external influences. So that's what comes out. I don't think I'm able to explain it well, but I think just acquiring that.
Yeah, I understood your point.
freedom.
And in
Yeah.
fact, I was also thinking about this, especially in retailers. In retail business, the USP or their unique selling point, why they do is because they get everything under one place, right? And the biggest challenge for anybody doing that is logistics. Now we are already into logistics, so we understand how this companies work. If we are able to do that, definitely we can run the retail shops. In other industries, it can be difficult. You have to create different values. But in retail business, where everything is combined, is the matter of logistics only. Same
Yeah.
time, managing things, perishable, non-perishable goods, and everything.
Because a company like Poundland in England, they operate their own logistic company. So I think I worked with Poundland briefly for about a month or two, And what I realized is that they have distribution centers, about 3 national distribution centers. So each of these distribution centers cater for a region within the specified region within the country. So they hire, sometimes they hire tractors and vehicles and all that to help them, but they are doing the management of the distribution, the logistics aspect of it. And I think that the flow of goods and decisions is quite quicker than actually merging with say another supermarket like Sainsbury's or that. So they really it was quite interesting knowing that. I mean, they when they receive the deliveries of goods from from the manufacturers, they actually do the distribution to their own stores. And so back haulage and sending goods and bringing it back, and these it's really related to how they operate. And so I think it gives them wide freedom.
Yes, that's a good example. Next, Suhas, you have any idea? I mean, you have any suggestion?
No, I'm just thinking.
Okay, take your time, no rush. Vishal, you want to add something?
Yeah, so I feel horizontal could be a better strategy. At this point in time, we have limited information. Obviously, when we have a scenario, then it all depends on what exactly is the underlying meat around it. But in principle, horizontal looks beneficial because you know what? I'm thinking from the lines of 2 out of 6 ports that they have, right? And I think the potential acquisition could be if I can go with the horizontal side of it, of a merger, wherein I'm looking for a company who already have either the remaining side of the ports, maybe 1 or 2, so that at least from that perspective, I am much more my service offerings is pretty much wide. Plus, it also gives me some bit of a coverage that I'm entering into. I have already entered into market, but I'm actually gaining a market share. So now horizontal, we'll always have a concept when you are thinking more of a market share, gaining market share. Vertical is something which obviously look at the backward or the forward. Now in this case, this also is an option, but I feel that the right now where company situation is, be it even looking at the financial point of view, or even looking at the market penetration point of view, I think we know for the fact that Carry and us, DAISTRUK, these are the 2 big firms that is operating the market with the information that we have. Now, assumingly that rest all companies are below these 2, so these are top 2. So if any small firms will be integrated and who has the port, it will actually give us an added advantage and a cutting edge, so that at least one, it will not cost us much because we are not acquiring a big company, but it will anyways help us in service offerings. So that way, horizontal sounds to be much more fruitful at this stage. Again, it all depends which situation we are in, how the market condition is, how many players do we have. It all depends on that, but that's what I feel.
Also, the competition authorities,
Yes.
will they allow us?
Yes. So there are many situations that we have to consider. Vertical, definitely it is, but then vertical, I would say that I would say backward integration would be something which we can look at. Forward integration could be the fact that if there is something beyond what we don't do. But I think vertical integration, I still don't gather much of the points for vertical, to be honest.
Right.
So for me also, I think the horizontal acquisition or the merger is more value added for us, because we are yet to explore, globally. So we need to expand and penetrate in the same market, where we have the expertise and we have all resources in place. Just we need to penetrate in the market further, so which is more easy for us. And looking at our competitors, I think we have to grow further in the same industry. And once we the market becomes saturated, then I think we can think of vertical the market for the integration. But then right now the horizontal is something which we need to think of.
Right. And obviously, what we are thinking here about vertical or horizontal, we can add that into our risk list also. Okay, because these questions we can predict, and usually that type of questions are only coming. I'll give you example of the last company, last to last, actually food delivery company. We have one stakeholder. We are delivering food for them, obviously. So they were so big. They are listed companies and they are bigger than us. We are thinking about vertical integration, but we even thought this company is so bigger than us. Why can't they acquire us? And in one of the variant, we got a question that they are trying to acquire us. Same thing now can happen with one of our stakeholders. We have one automobile company that is so big, right? They're operating in around how many 80 or 90 countries they have mentioned. So there is a chance of some companies also trying to acquire us.
You're talking about Murdoch?
Murdoch is also there, and one more.
I feel
Malta Motor is there, no? 52 factories in 31 countries.
Yes.
Yeah, and I feel Murdoch chances. I mean, this is what I feel is that because there's higher chances when there's some big player entering, probably it's for them it's a backward integration or in terms of vertical merger, the backward integration for that company. But there are high chances because it will actually ease them off if they acquire this. This will actually help them. Or probably, sorry, I said backward. It should be forward integration for that company, because they're going to be, transferring goods from one place to another. So that way, possibility.
It will be vertical backward only for Murdochs, most of that. Maybe logistics we are doing both, but for Murdochs, if they acquire us, it will be backward.
Backward, right?
Yes, vertical backward.
Vertical backward. Then I said this first time. Right. Okay. Yeah, but the chances will be higher in this case because I feel that the company is big, really big. It's like a shark in the ocean. So probably the chances of we getting acquired is, in my view, is higher compared to what we can acquire.
Yes, we acquiring Murdochs is a very rare probability.
No way.
Yes, Farah.
So just going after what Vishal said, yeah, I don't see it. I don't see it being plausible that we get acquired by Carry or Murdochs or the motor company, because we're significantly smaller than all of them. It doesn't seem right that we'd go after such a big company. But then my question would be is, let's say Carry wanted to acquire us or Murdochs wanted to acquire us. What would the Tara be? Would we try and avoid that? How would we avoid it? Or is it that we just accept it?
Right. So there are two answers. First, Carry acquiring us probability is very low. Reason being, imagine Carry is similar to us. We have 2 ports, they have 2 ports. So when the market is run by one company and we have around 25 to 35% share, the competition authority won't allow us. Why? Because it will create a monopoly in the market. Okay. So if we acquire Carry or Carry acquire us, I think government won't allow us. That is for sure. Secondly, now Murdochs acquiring us. Why Murdochs will be very interested to acquire us? Because obviously they are giving a lot of business to us and a lot of their money is going into logistics. As this business, their main expense is logistics. If they acquire us, they can save a lot of profit. They'll save a lot of money. Now, third parties, what DAISTRUK should do. So who is the owner of the business? The shareholders. So the shareholders would ultimately decide to go for it or not. As a board, as a member of the board, you are reporting to the board. So you can just recommend what is best for the company. Sometimes it can be a hostile takeover. We are not interested, but they are just, advertising to our shareholders by giving them double money or triple money than the current valuation. Then they might sell off. At the same time, if we feel like it is not worth it, we can just communicate with the shareholders and gain their confidence and say, we have to wait for some time. We can even grow 5 times, 10 times bigger than our current position. It's a very good question, actually. We are going to discuss that point in the next chapter.
Okay.
What to do when we are getting acquired.
I guess when I was doing my risk assessment, I guess I knew that they were a risk of acquiring us. But I guess my question was how would our stance be? I guess if they're offering a lot of money that overvalue, then it's plausible for the shareholders. But then there is opportunity for us to grow and go into different markets and diversify. We don't want to. We would stand to make more money doing what we do because we don't just work for Murdoch's. Yes, they're our biggest customer, but we do other stuff also, and we could increase that.
Yes, so you are right what you're saying. We can grow more individually, but the owners, the shareholders should get the confidence what we are saying now. If you are failing to convince them that we can grow on our own, definitely we cannot stop them. But if you are able to convince them, then we can easily stop this from happening.
Okay.
And with this change, the impact of on the share price.
Yes.
Because it's too fluctuating. We reached 15 versus the low of 4. So it's quite a variation. If you look at the last, I think 20, 30 hours, I think whatever the time range that is given, not sure. But yeah, it's like quite a volatile situation for DAISTRUK, right? So from 4 to 15, and currently at 11 somewhere, I think high chances that obviously stakeholders might also think through that this is the right way. I think from that perspective, when somebody stronger than us acquire, obviously the brand and everything will also change. The brand value, the goodwill, and everything will change, right? And impact is on the share price eventually. So that could be one thing that can be critically assessed.
Yes. And if Murdoch is serious, even if we don't sell to them, maybe they'll approach to carry or other competitors. It will be a game changer for the industry.
Yeah, but not sure if Murdoch is actually tying up with Kerry somehow, but we don't know that yet, right? So it could be possible that they can change the contract from us to Kerry. That will also change the game for DAISTRUK.
I'm saying not only the contract. If they try to acquire us, and let's say our shareholders are not happy to sell, but Kerry shareholders are happy to sell.
Oh yes. But in that case, the market will be different, right, Ms. Ba, in this case, because it will help us if Kerry get acquired by Murdoch, isn't it? Or maybe I'm thinking differently.
I mean, it can help, but I don't think Murdochs just want to acquire this logistic company for their retail, but obviously they want to diversify their business. They want to look as a conglomerate. They won't stop the operations. In fact, they can pump in more money and make it more stronger.
It's a bigger threat, isn't it? Because we go from losing our contract because we said no to them possibly acquiring Kerry, and then not only losing that business that we had, but also them being a stronger competitor.
Exactly. If they only want logistic support for their business, then they don't need to acquire company as big as DAISTRUK or Kerry. They can acquire smaller logistic company. They can take care of their business. Then it's fine.
I think acquiring acquisition by DAISTRUK looks to be a fair, feeble chance, Ms. Ba, because even if I look at balance sheet, right, we don't have cash, okay, and retained earnings is going into payouts. Now, I feel that where will the money will come from unless it's funded by borrowings, and borrowings paying capacity. I don't know how much we have, but it looks like unless we go with the borrowings, external borrowings, we don't have money inside the company
Yes.
at all. I mean, so it has to be physically very strong. I mean, from a feasibility standpoint, it has to be a very strong decision if you have to really go for acquisition, because the synergy has to be pretty predefined as always. Otherwise, it will going to actually impact the company's position. Because I feel looking at the balance sheet, it is not a very strong company. Because while your inventory is low, which is good, but your cash is nothing. Your return earnings is diluting. So it's like a situation where you have to follow through every single year, and the payouts of dividend is quite high. That's what we discussed yesterday. So all this put together, it's like the sustainability is a question mark for me, at least for DAISTRUK.
Sustainability from the point of acquirer, you're saying?
Yes.
Yes. So if they have to acquire us, it's not because of our money, but maybe other reasons like brand name, other intangibles, other access, what we have,
Big data, our information.
big data, information, operating. We understand the entire economy of Roundland. We are there for more than 60 years, right? We would have seen a lot of good and bad times. We know the culture very well, the political situation and everything. Maybe that way it can be useful, not only for the cash, obviously, which we don't have much. Excuse me. Yeah. Now going on to the next part is what is big data. I think we are aware. Next is reasons why mergers and acquisition fail. We have to understand globally in the real world also, more than 50% of the M&A will fail. Mergers and acquisition will fail. So what is the reason? First is
Sorry, Misbah, I am interrupting. I just had one thought, little different, but it just came to my mind. You can even park it for now. When I talked about cash just now, okay, even if I look at carry position, it is not that strong. Do you feel that is something like the cash conversion is a question mark for such logistics company, because holding such a low minimum amount of cash and diluting the retained earnings? What is this? Is this usually prevalent in the logistic firm? Because I am not sure. Maybe I have to do some bit of a research, because to me, if you don't have sufficient value of cash, either your operating cycle is not very strong.
right. That may be one of the reason why they paid out higher dividends, just because to satisfy, because shares are also not performing good.
That's correct. Yeah. So that's something which I'll research a bit, because in general, I'm not sure. I haven't seen much about the balance sheet for a logistic firm, but I'll do see. Is this the ratio that everyone carries it, or maybe probably this is unusual, because I've seen any sort of a service or a manufacturing sort of a setup. Obviously, the balance sheet looks different, but the cash is something which is quite low in our firm. So, anyways, that's what my thought was, independent to what we are discussing.
Yes. We'll discuss this and we'll compare to DHL and other companies' balance sheet when you're doing industry. We have it available publicly.
Okay, good. Thank you.
All right. Then what is the reasons why mergers and acquisition usually fail? Some of them are the lack of fit syndrome. Lack of fit can be, maybe everything looks good on the paper, but the management style, the corporate structure, and the way of working, some companies are more ethical while others are not. That may be the reason. Second is lack of industrial or commercial fit. Failure can result from horizontal or vertical takeover, where the acquired entity turns out not to have the product. Now, if we acquired this Murdoch's, or Murdoch's acquired us, so definitely things might look easy from outside, but managing this kind of business, if you don't have experience, or if you don't have anybody from the board who has been part of that, can be a very difficult challenge. And obviously, most of the time, the acquired company or the target company's employees will also leave once they have acquired, with the fear of redundancies. it can make even worse for us to maintain it. Next is lack of goal congruence. Disputes over the treatment of acquired entity might well take away the benefits of otherwise excellent acquisition. Sometimes, especially if you are going for share exchange, where the power is still there or some power is still there by the target companies or their management, there will be a lot of disputes coming in. Next is cheap purchase. Sometimes companies only acquired loss-making companies and they feel like they're expert in that. They'll just easily turn it around. But it can lead to another problems. Sometimes they have litigation, sometimes they have a lot of loans to pay out and a lot of other reasons which can make it a loss-making company. Paying too much can also be a problem. Let's say we have overpriced and we have paid very high to the target company. Maybe the valuation was not good. Then whatever synergy we are getting is lower than how much we have paid. Then straight away it's a loss. So all of this can be done, or this risk can be managed through due diligence. We'll discuss this, how we can manage all. Yeah, Farah.
They're paying too much. It brings up an example of when Ford in the UK bought Jaguar, and the assumption was because Jaguar was so, it's a luxury, seemed to be a luxury black brand. They assumed that when they bought that, they would be able to kind of, go into that market. But what happened was because Ford's name was attached to the new X-type Jag, they didn't sell much, and they ended up having to sell off to someone else because of the assumption that Ford was a cheaper cost. No one would buy it.
Yes.
So it's perception as well be banned. If you're perceived to be a low cost brand, but trying to enter a different market in that scenario, that could be something that could you pay too much for, but then would fail.
Definitely. And especially the smaller firms or the medium firms, this is done by bigger firms also, but for smaller firms it's little easier to show their price high. They will just cook the books or they will show other things. Usually they'll use cash flow based valuation, or obviously the valuation which suits them the best. The bigger companies can end up paying very high. Then very big reason why they fail is integrate effectively. Integration won't happen on its own. It might take 1 year, 2 year. So the company should have patience for that. They should have every plan from the start. If it is international, then again it's a bigger risk of culture. Then we can have change managers coming in. Then we can have change leaders. We have to give a lot of incentives. We have to keep a very flexible budget. All of these problems need to be solved step by step before getting integrated properly. Because once they get integrated, then only the synergy can come out. And sometimes we are talking about economies of scale, that means we have to make redundancies. So a lot of people will object that. And sometimes the people you need might also go away. So managing all of this can be a uphill task. Then inability to manage change, similar to that. Many acquisitions fail mainly because the acquirer is unable or unwilling reasonably to adjust his own activities. They have to give time, they have to understand their business, especially if it is a new industry or new business, it can be a very big problem. What kind of synergies usually companies get is economies of scale, economies of vertical integration. They can get complementary resources. Obviously, synergy is more when you are getting the business in your own industry, especially horizontal. Okay. Financial synergies can also be there, diversity in financing. Through P, we can show a more valuation to the business. Other synergies can be managerial talent, market, or cash. Sometimes we just acquire because of the cash, speed. Right. Anything is missing here in the synergy? What else is synergy when we acquire other companies? Or basically the benefits, if not synergy. Risk management. They have not mentioned that. Risk management is also there, especially when you go into a different industry, right? Okay. And yeah, they have given some 7 points. Do you think some more points can be added here? Why M&A could fail? Culture, very important, the most important, in fact, in international, especially. What else? Anything else? Planning, we can say we have to be very proactive in the planning. It's a little bit relevant to this, but planning is very important. Like here also they have mentioned, the plan must be address such problems as difference in management styles, incompatibilities and everything. Or other times what companies do, just to plan properly, first they will go as a strategic alliance, joint venture to understand the business. Then they will acquire it. Okay. Tax implications also, we have to be very careful when it is international business. Obviously companies don't want to pay double tax. At the same time, the government don't want to lose tax. So just to find the middle way, OECD, or we can say Organization of Economic Cooperation Development, they have come up with the plan in the middle where the countries also don't lose the tax, whereas the companies also don't need to pay the double taxation. Otherwise, what was happening, a lot of these companies were showing most of their profits in the tax havens only, where the tax is very low or there is zero tax. What companies usually do if they are in international business, they will show higher profit where the tax is lowest, or sometimes they will show losses in the place where the tax is high. Group loss relief also they can do. Members of a given companies may surrender losses to other profitable groups member forecasting accounting periods. Losses surrender must be set against the compliant company's taxable total profits. So basically companies are trying to find loopholes, then government is improving their controls. All of this is continuously happening. But as a DAISTRUK, we have to see ethically what we can do, which is benefit for our company also, and which is accepted by the society and the government also. Withholding tax and everything. Competition authorities, we already discussed. Competition authorities' main role is to work in the benefit of the society. Anything more than 25%, they will see as anti-competitive. They will see it can lead to monopoly. It's not always they will stop us. Sometimes they will just take time and they'll just delay it so much, the deal might get cancelled. Divestment is also an option for us. If some of the part of the business is not doing good or we need money from that, we can do divestment. Sell off, spin off is also. Management buyout. When we are selling some part of the business, instead of selling it to outsider, we can sell it to some of our own management or the management who was handling that. If they are able to arrange the finance, they can buy it off. They can arrange the finance from venture capitalists. They can take their own loan, or if they have their own money, lot of ways they can finance.
So is this if we decide to buy shares from specific people? Sorry, is this if we decide to buy bring back the share? So buy it with it, take it back.
Management buyouts.
Yeah, can you explain that again? I didn't understand.
Yeah. Let's say now we are doing this railways also. We are doing with road. We are doing with airways. Everything we are doing logistic. Okay.
Mm-hmm.
Now let's say in air transport we are not making much money. It's very expensive. So now DAISTRUK management is saying, let's sell this, divest this part of the business. We'll do only roadways and railways.
Okay.
Just imagine. So instead of selling it outside, they can give an offer to the current team who is managing that, the senior managers who is doing that. Are you guys interested to buy that?
Okay.
If you're interested, we'll give it to you. Otherwise, we'll sell it to someone outside. Because if we give it to them, they will not lose their jobs. They have already experienced that. So they might run it on their own. Only thing is they have to arrange the finance. Usually it's very expensive. They don't have the money.
Yeah, I get it.
And other considerations we might have to do is, firstly, do the current owners wish to sell? If you think from the management team, and otherwise potential of the business, will they able to do on their own? Because there will be no head office support now. Then quality of the management team, are they capable of that? And the most important is the price, how they'll manage the price. So again, they can just look at it as a startup kind of thing. They will go to VC by giving the equity. They can go to banks. They can go to private equity firms. They can go to other financial institutions or leverage buyout.
But if this were to happen, so let's say it was, well, Doreen is the only person that would be the person dealing with this. If we sold it to Doreen, let's say the airports, we would lose Doreen, who was a big core competency of our business. So that would be very risky for us, because we'd lose our executive who was dealing with all of that.
Yeah, usually this divestment or selling of the business we don't do for our core competencies. We do it only when it's making loss. It's not helping us in any way.
Okay.
Yeah, they have the disposal part of its activity by an entity. What are the reason? The sum of the parts of the entity may be worth more than whole, or it is very less profitable. It's unwanted for us. We want to focus on other areas, or maybe we have changed our plan for the strategic decisions. We planned something, but now we are not interested in that. Let's say we went to Eastland, and after some years we feel like Eastland is not worth continuing. Let's go to Westland. So whatever we do in Eastland, we sell to the senior managers there. Obviously, we will not or should never give away our core competencies. In the worst case, if the company is making losses, then we can sell some of the business which is performing good, but again, the least performing. You want to have the minimum loss. Here also they have mentioned here, sell-off is the sale of part of an entity to a third party, usually in return for cash. Why we are selling it? Because it's less profitable, or maybe you want to focus on the main business, protect the rest of the business from takeover, to generate cash in time of crisis. Farah, does it make sense?
It does. I get it now. Thank you very much.
Sell off. There is another thing called spin off, or it's also known as demerger. This is usually done to know the actual value of the company. Now we can have this DAISTRUK can become two company. We can just divide what we are doing on railways and roadways and what we are doing through airways, logistic companies, or we can just divide logistics separate, warehousing separate. That's also possible. One of the reason why we are doing this is to make shareholder understand the overall value of the business. Secondly, just to avoid any hostile takeover of the business. Let's say somebody want to take over completely. Now we'll make it separate. They'll be legally separate entity. However, the owners will be the same. The shareholders will be the same. Though they can come back again and be together. It will clear management structure and it will help in a lot of things. Obviously, the downside will be it can be little costly operating both separately now. There will be not much economies of scale or synergy. That is spin-off or demerger. Yeah. Makes sense?
Yeah.
All right. Financing and MBO, they can just get the money and it's sorted. In fact, the management as DAISTRUK, we should also understand, will they be able to manage the company? Will they be able to get the finance? Otherwise, we can sell it to an outside. Then suggested financial structures mostly for MBOs. They can take loan, they can take senior debt, junior debt, just like normal debt we talk about. They can go to VC or equity. What is the risk for us or for the company? You can say bid offer price by MBO team might be too high, lack of experience, loss of key staff. You just mentioned, right? This is a risk for DAISTRUK if we do that. Loss of key staff who either perceive the buyout is too risky or do not have capital to invest. And we are losing their staff as well. They won't have the finance. We want to help them, but at the same time, they won't be capable to do that on their own. And to convincing the employees, the communications can also be a big challenge. And now if you talk about the people who are investing in MBO, obviously venture capitalists and other people who are investing, what they look first before investing the money, they'll say how they can increase the money, obviously multiply the money, and how will they will be able to sell it. So the best way can be the MBO itself, the small part of the business becomes so big that it goes for listing, that is IPO. Second way, the company will grow and they will sell it off to other bigger companies, that is trade sale. Last one is independent sale. The company could try to increase their shareholding in the company, buying out the other financials. Let's say the management itself becomes so rich and they buy off this VCs. Three options they have for the MBS. Very rare for our case study how they will go out and all, but just for the understanding. Because when anybody is investing in the business, they will see what is their way out. Okay, they'll earn the profit is fine, but they don't want to stuck in it forever, isn't it? And not all the companies can become as big as to go for IPO or listing. Okay. Any questions? We have another 10 to 15 pages, business valuation and post acquisition issues. Shall we continue? I hope you guys are not tired. If you want, we can take 2-3 minutes break and resume. It's better if we finish it today. Just give me suggestion.
I'm okay.
I'm okay too.
Me too.
Okay. So let's take 2-3 minutes break, then start. After the break, we'll go for another 20 minutes at least. Yeah, 20-25 minutes.
Hello?
Yeah. Shall
I'm
we
here.
start? Yes, we shall. Others, are you guys there? Shall we start?
Yeah, let's go.
Yeah.
Excuse me. All right. So, chapter 12, business valuation. So, when we value any business, whether it's a listed company like DAISTRUK or a smaller company, a sole trader, anything, there are a lot of things that affect the business. Okay. Some of them they have given here like reported sales and profits, basically profits for the business, future profits for the business, types of the industry, if the industry is growing up or industry is going down, the competition in that area, the level of competition in the industry, range of products sold, range of product as in are we focusing only on one or our portfolio is diversified, breadth of customer base, because in certain industry getting customer is very difficult, getting that type of customer is very difficult. Then the last one is perspective. Ultimately it's all about perspective. If the buyer and seller is happy, whatever price they want to buy and sell is finalized. But usually these are the things that get affected. Okay, I mean these are just examples, but we can add some other things like the level of intangibles they have, the urgency of the buyer and seller, the government rules and regulation there, the legal requirement for the sale. Let's say if there's a lot of documentation and a lot of things required, then it will demotivate the buyer and seller. Then if it is a international buyer and the rules are not supporting, then again it will affect. There are a lot of reasons that can affect the value of the business. Okay, for example, nowadays we can see tech companies who are just making losses, even fintech companies who are making losses, but they are promising for the future. Their valuation is so high compared to other businesses which are making profit. Why? Because they know this industry is for the future. Same thing if you talk about logistics. Now the dependence on logistics is even increased, especially at the micro level now. Last mile logistics, because now people are working from home, groceries, medicines, everything is getting delivered at home nowadays. So now the demand for the last mile logistics has even increased, and ultimately the mail logistic will also go up. And one of the reason why a lot of globalization is happening is because of logistics, easy logistics. The types of food, clothing, and other types of cultural things are easily available in whichever parts of the world we are. So definitely the logistic industry we talk about, it's quite promising. The only thing is the way it works and other things can change. One of the biggest risk of this industry is it can get nationalized. We have not talked about this, but it is possible. What if tomorrow the government of Roundland want to acquire our company? Or they just want to acquire everybody here and nationalize it? That's also a very big risk. Okay. Is there anything more which will affect the value of the business?
But if the government, sorry, Ms. But if the government wants to nationalize it, this risk can't be mitigated, right?
Yes, this risk cannot be mitigated. We have to do the scenario planning. We should have our risk sensing tools ready to know, because when government come up with something, they have to, democracy, they have to go to parliament, and a lot of other things will be there, especially when it's such a big industry. So in the meantime, we have to diversify our business. We have to go into new industry. I think DAISTRUK, with their brand value of more than 6 decades, and they understand the industry, the culture, if not this industry, but they understand the business of Roundland, how it works. So if they go into new industry also, they can survive. Like if you talk about India, the Indian Railways is entirely owned by the government. I think now recently I read news, I'm not sure, they're saying some few trains, private trains are also started running. I'm not sure
Yes.
that's true, right? Yeah.
Pages. Yeah.
But now freight and everything is totally owned by the government. So same thing can come in for us as well. Or maybe not in all three ways of transport, they might come only in railways maybe, or only in roadways. But nationalization is also a risk for us, because logistic is the primary expense. If logistics is taken care by the government, obviously they don't want to work for profit. They can reduce the cost of logistics. Ultimately, it can affect the cost of the goods. But how effective they will be, it's always a challenge, because private people or private companies will be more effective usually than the government. Anyways, that's a different thing. Yeah, any other point we have missed here which can affect the value of business? In general, we can talk about, not specific to DAISTRUK here. Okay, one more point I'll add is how you are making the payment. Are we making cash? Are we making share by share? Okay. Or are we giving them some other assets like counter trade? That will also affect the value of business. Usually cash sales can get discount. Anything else?
Brand value, are we missing in this list? Maybe how reputed you are in the market, and then it depends.
Yeah, so yes, you're right. Brand value, goodwill, basically all the intangibles also. Okay, the list can go on and on. Okay, so next is the key terms. What is listed, unlisted companies? We have just discussed this in the previous one. Yeah, what they're trying to say here is, when you're acquiring a listed company, it's very easier. You just see the share price and number of shares, you'll get the value of the business. But when it's unlisted, it's little difficult. Sometimes what they do is they find a unlisted company. So what they do, they find a similar listed company, then discount the final price to 25 to 35%. Let's say the listed company was 10 million, so they will say this unlisted company is 7 million or 7.5 million. Reason being, because it is unlisted, then we have to reduce the price, because the shares are not marketable. They're not going through a lot of scrutiny. They might not have proper corporate governance, internal audit, and all of this. Again, these are all just assumption to come at the rate. Finally, it's all about the buyer and seller's perspective. So what is important for us here is, for the exam perspective, is you should know the different types of valuation method. And you might sometime have to recommend one of those. First is asset-based valuation. As the name suggests, asset. So you just have to add all the assets in the business. Plus, there is also probability of now adding intangibles. But the intangibles here is not very much clear. It's just approximation of the industry standard. Okay. So asset value plus the intangibles, you'll get the asset-based valuation. Usually this is used for the companies with very high assets. But nowadays, even manufacturing companies which have heavy assets, they also have very good amount of intangibles. So this is very least used valuation of the business. However, this is more useful when we are closing the business. When we are just closing any business, or we are buying a company when it's about to close, they don't have good intangibles or anything, we can just do the asset-based valuation. Why? Because it will give a minimum value of the entity. Minimum something like that. Okay. How CIV is calculated and everything is not important for us. Next is earning base. So what is the earning? And obviously in asset base, the problem was it doesn't forecast what we'll do in the future. It's only about the current asset. So earning base will take care of the earnings, what we are doing, what kind of assets we have is not directly related, but out of that asset, how much earnings we are creating. What is the forecast earning we have? So for service industry, especially, earning based is a very good way of valuing the business. However, the downside can be it's just forecast. We don't know that thing will happen for sure. So strength for this can be commonly used, relevant for valuing controlling interest of the entity. Weakness is just about accounting profits, and accounting profits can be booked or can be cooked. Some companies usually want to show less profit just to save tax and other things. And when we find this, the formula says we have to do the P ratio, that is done by our earning per share and everything. So that can also be very difficult to find. Difficult to establish relevant level of sustainable earnings. Though we are saying that it will come, but we all know finding a relevant sustainable earning is very difficult because a lot of risks are uncontrollable. Earning yield method is very similar to that. Then last one is dividend valuation model or discounted cash flow. So here what we are doing is the valuation of the business is totally dependent upon the dividend we are doing. Okay, this is very similar to the previous one also. Imagine if we pay 100% of the profit as a dividend, though it's very rare probability, but one business is giving 100% profit as dividend. So the earning based valuation and dividend based valuation will be the same. Okay. So dividend valuation model. The value of the company is the present value of the expected future dividend discounted at shareholders' required rate of return. So whatever dividend we are giving and how will be expected to give in the future, based on that, our value of the business will be there. Yes, Farah.
So if you were to value DAISTRUK, this would be a good valuation model because we pay so much in dividend.
Yes, this can be good. However, I don't think we can grow the dividend continuously. Constant growth. We have to show what is the dividend now and how much will keep on growing.
Okay.
Yeah.
Okay,
So
so
dividend model can be good, but if you talk about the industry in general, usually service industry like us, earning based valuation is good. We have to value in such a way where we get the maximum valuation. Simple as that. Yes, Vishal, you're saying something.
it was me, Emmanuel.
Emmanuel, yeah, please.
So I was going to say that if so for carries also, or maybe a similar competitor appears, and then they are paying they are making profits, but they are not paying as much dividends as we are paying, and so just purely based on how much dividend we are paying will mean that we are more valuable than them. Is that the case?
Yeah. So basically, just try to understand simple. Suppose it's my business. Okay. Now I have these three options to value my business. Which one I will choose? I will choose the one which shows the maximum value of the business. If that business is not giving high dividend, so definitely they won't value their business based on dividend valuation.
Okay.
Right. Yeah.
Right.
Secondly, the second person to value is the one who is buying the business. For example, now if somebody comes to buy that business, you will say, I have done the dividend valuation model and your dividend is very low, so your value is low. It doesn't show good growth in dividend also. But that person will disagree. They will say, we value our business based on earning base. Like that.
Okay.
So for the seller of the company or the owner of the business, they will try to find which one is more suitable for them. Imagine a service industry, if they do asset based valuation, what they will get? They'll get nothing. Right? Their value will be nothing on the paper compared to what is their actual value. Because service industry, it's more about their future earnings, the brand value and everything. These are just suggestion to value the business. Whichever suits for the company, they should choose one. Make sense? Or there are some people who just work on business valuation. They're experts on that. They do some studies also for that. There are a lot of diplomas in the market. So if you ask them to do the due diligence, let's say you want to buy my company and you can just give them work to them. Now they will come and decide, okay, which valuation to use. So they'll understand the business operation first, then they will try to see that. Is that okay, Emmanuel?
Yes, okay, that's fine. Thank you very much.
So how it will be tested for us in CIMA exam is, they will ask, or they can ask, what are the types of business valuation model and which one we should use to value the company. Usually it's not our company, but the target company. So imagine you're buying a company which is close to receivership. So what you'll recommend? You'll recommend to the board, do asset-based valuation. But if you're acquiring a company which is promising, which has good brand value, good business, then you'll recommend earning-based valuation. Like that.
I've actually seen a question on the potential to, acquire, or the feasibility to acquire an unlisted company, a supplier. So, well, I think that what we discussed earlier on before this, as in actually exploring within the industry and knowing which company could be matched, which quoted company could be matched, and then maybe discounting the value of it. Will be an approach to actually recommend whether we should go for it or not.
Yes, that's also one way of doing that. Yes.
Great.
Yeah, we'll do questions so you'll get an idea. Okay, a lot of assumptions, calculations. I'm not taking you into that. It will be more confusing than helping us. Okay.
Yeah.
Discounted cash flow similar to that. A value of the equity of the entity is derived by estimating the future annual after tax cash flows of the entity and discounting this. Anyways, you can just think of 3 years. That's fine. One is asset based, earning based, and dividend based valuation. Okay.
Is the discounted cash flow just looking at the MPV?
Yes, kind of. So they have given cash flow to equity, cash flow to invest. This for the more of calculation basis, how to calculate it. Okay. This chapter is the most important when we do individual F3. Some of you have written it, so you will understand it. 40% of F3 is about business valuation. So how to calculate the formula, what is systematic and unsystematic risk. If you remember in the pre-scene, we have talked about beta. What is beta? If you remember, okay, the method adopted by CAPM to measure the systematic risk in an index is beta. The beta factor is the measure of the share's volatility in terms of market share, how risky it is. What is our beta factor?
1.227.
1.27, yes.
1.7. So here the share have more systematic risk than the stock market. So we are 0.27, 27% more risk here. If it was 1, so we'll say same. If it is less than 1, we would have said it's less systematic risk. If it is 0, there is no risk. However, it's very rare that it will be 0, almost impossible. We are 27% more risk. So what is 27% more? Systematic risk. Imagine unsystematic risk, everything is taken care of. But systematic risk, we cannot do that. Okay, what is systematic and unsystematic? Quickly, we can go through that also. Systematic risk first is a market risk. Is the risk of the company's cash flows being affected to some extent of general macroeconomic factors such as tax rates, unemployment, or interest rate. Basically, things which are external to the business. Can we control external risk? Mostly, no, we cannot control, isn't it? That is systematic risk. But unsystematic risk is the risk of the company's cash flow being affected by factors like strike, R&D, success, system failure, basically internal. So what we are assuming here is all unsystematic risk or all internal risk is already being mitigated. But still there is a half risk or another type of risk, systematic risk, which you cannot mitigate. So our market risk is little bit higher than the normal. That is 1.27. That is a good sign only, because usually bigger companies or industry leader will have more beta itself. It's very rare you have equal to 1 or less than 1 beta and you are a market leader. Clear? Usually they won't ask, but just for the understanding. Now they are talking about the formulas here. It's not important. What they're trying to say here is when the shareholders are expecting more risk, when the beta is more, they'll expect the returns also to be more. That's what they're trying to say here. Then this is a formula to calculate the value of the actual business. Numbers or calculation is not required for us. Then there is something called EMH, efficient market hypothesis. This is important. We'll go straight away directly to the semi-strong. We live in semi-strong efficiency. That means whenever something is in public, imagine there is a news about DAISTRUK tomorrow of working unethical. What will happen? The share price will go down. Why? Because we are into semi-strong form of efficiency. The share price reflects all information that is publicly available in press report, financial statements, or news, anything. There are other two forms also. One is weak. Weak means the share price is not reflecting anything. Let's say there is a news also, they don't react. This almost doesn't exist. Okay. Another form is strong. This is rather unethical or illegal also, we can say. That means internal information. Let's say we have a meeting today that will acquire certain company and tomorrow share price going up. What does it mean? That means there are insider people who are giving the news outside. That is illegal or unethical. We cannot have this. So where we operate is semi-strong form of efficiency. If this happens, means we should have a policy to find the or manage this risk. Is this okay?
Yeah.
yes.
Then impact of business valuation also. You know, the valuation will change. If the share price goes up or goes down, definitely will affect the business. Now the last chapter and the important one, we'll go back to the thing. Like for I mentioned, you know, we'll discuss if somebody try to acquire us, what we can do.
Yeah.
Excuse me. So there are two situations, pre-bid and post-bid. Pre-bid means we are on the assumption that somebody can come and acquire us. We are not 100% sure, but we are expecting that this thing will happen. That is pre-bid difference. So before itself, we'll communicate effectively with the shareholders. You know, our business might have seen some share price fluctuations, but we are in the strong position. We'll grow in the coming time. Our share price will go up and a lot of other things. Basically, gain the confidence. That is one way of pre-bid defense. Second option is you revalue non-current asset. Usually, if you see a non-current asset, we take from book value. And in the real world, the value of the asset goes up, especially property and all of this. So if you revalue automatically, the value of the business will go up, which can be demotivating for the seller. Remember, first point, we are just talking about hostile. Hostile means when you don't want to sell, when something is happened as a, you know, somebody is forcing you to do. It's not by your free will. If it is by free will, obviously you don't need any defense, isn't it? Right?
Yeah.
Next is poison pill strategy. Target company takes step before a bid has been made to make itself less attractive. Let's say we have a lot of cash, which we don't have now. Imagine. Then we'll just invest that cash somewhere. Then they won't come to acquire us. We try to just find out what are the things they are looking in us, why they are targeting only our company. So we'll try to go away, you know, or leave that thing away. The next one is super majority. We can just change some of the rules what we have. Let's say previously it was if they get 51% of the shareholdings, the ownership is gone. But now we try to change the rules. Let's make it 80%, 70%. Just make it more challenging for them. These are the famous pre-bid defenses. We can even look at this. If we are targeting some company, they can also play all this. So we should know how to react to this as well. Or respond basically. Yeah. Now imagine after doing that also we have got a bid. Now what we can do? We can again appeal to our own shareholders by declaring that the value placed by the target company share is too low. maybe they are giving 3 times the current share price. We can just convince the same way, saying, they are giving 3, but we give you confidence that we can go 10 times in matter of 4-5 years. Next is attack the bidder. Concentrating on the bidder's management style, overall strategy. You can just say, that company is not ethical. They will not be good with their promises. They will not try to, give you the promises what they have done. They'll make a lot of redundancies. All of these things. Next is white knight strategy. Excuse me. The target company offers themselves to more friendly outside interests. So we can just say, instead of buying us, why don't you acquire our competitors? We can help you. This is little unethical, but it's a tactic we do. Please leave us, but target another company. If you do that, we'll also help you. Then last one is pretty rare, especially if the acquiring company is very big. You can just say, instead of you taking over us, we'll take you over. We'll arrange the money. We'll take loan. We'll find money from anywhere, but we'll buy you off. It can happen if both are very closer, but it's very rare when the other company is quite big. It's just to threaten them, saying that, we are also very strong and powerful. We just don't look like that on the paper, on the financials, like that. And last one, if you feel this is going to create something which is anti-competitive, unethical, or against the competition law, we can go to the competition authorities, or we can go to the government or court of law, all of this. So this is pre-bid and that is post-bid. Any confusion here?
No. Okay.
Again, all of these are suggestion. Companies can do beyond that also. There is no thumb rule that or any law we should only do this. But these are certain things which are more acceptable. Then now DAISTRUK will go in a situation now that DAISTRUK is acquiring someone. Okay, we'll take from that example because that is more usually asked in the exam. So first thing, let's say we are acquiring certain company. So what is the next thing we have to consider? Next thing is, how will you pay them? Will you pay them by cash? Will you pay them by share for share exchange, or will you pay them by earn-out? So cash, obviously cash is like we just arrange the cash through rights issue, or we take loan and we pay them cash directly. Simple as that. Second is share for share exchange. Will give the ownership in the business. Now our current share price is 9. Assume it's 10. Okay. Now if it is 10 and if your target company share price is 5. So what we can say? Okay, you come to us, we'll give you 1 share for every 2 share you held. Or sometime we have to say we'll give you 1 share for every 1.75 shares you held, because we want to give them a premium. That is share for share exchange. So these two are 2 primary methods to take over a company. Third is earn-out, but earn-out is usually mixed. Earn-out is something like you give them some cash or some share for share exchange and say, remaining I'll give you when you help me to achieve my target, when you help us to achieve the synergy. Okay. This is very important. Again, a very common topic asked in the exam. Okay. So first we'll discuss about cash. Cash is suitable usually for what? It's very logical. Suitable for small acquisition. Can we do millions and billions in cash? Very difficult. And even if we do, we cannot raise that much money. Then the amount of tax it will have on the target company shareholders. So what can be the advantage and disadvantage if you do by cash? Achieve quickly. Less risk for whom? The target people. If they do for share exchange, if share price goes down tomorrow, they don't have any control. So less risky. Increase liquidity to target shareholders, or maybe we can get cash discount as well. Disadvantages. Usually for us, DAISTRUK might have to borrow the money, or sometimes we have to do new share issue, rights issue to borrow the money. If you are doing through equity or debt, depend. Target company shareholder may be unhappy. Some people don't want to give away the ownership. Some shareholders, they're okay to get acquired, but they want the ownership to be retained. Secondly, the tax will be very high in some jurisdiction. What else can be disadvantage if DAISTRUK goes through cash for acquisition? Just one point. Very logical.
If we're acquiring, or if someone's acquiring us?
If we are acquiring, because that's most of the scenarios we'll face.
If we're acquiring someone, then the advantages of cash is, well, I guess it's quick, it's fast, it's done. There's no the control, I guess, would be exchanged pretty quick.
Yeah, we discussed this point. It will be really quick. We can get some cash discounts.
I guess the control, well, I guess when I say quickly, I mean the control would be exchanged faster, as opposed
The
to
overall process will be done faster. Yeah.
We'll save more on interest cost if we go ahead with the cash. It's the advantage for us. But then at the same time, disadvantage is if we encounter any kind of emergency or any requirement suddenly, then since the DAISTRUK has no other huge investments in the assets, despite the except the trucks and the warehouses we have, which is again our core business, then to mitigate that emergency will be a problem, the challenge for us, because we don't have cash once we pay out in the takeover.
Save interest means how?
Same. I mean, if we go with the cash, then we don't go ahead with the market financing options, and then the cost will be saved in that option. And then to evaluate some other financing option, the doing some research and to find out the ways will also time consuming and costly matter. If we have cash, we are using it, then we are saving our time, and at the same time the interest will be saved if we are going ahead with the financing option or the debt option.
That is subjected to having the cash. Usually we don't have that amount of cash.
Yeah. I mean, yes, correct.
And we don't have here as well. The retained earnings is quite low unless it's very small acquisition.
Yeah, that's why the disadvantage is biggest, because if even if the small acquisition, if we pay out with the cash, then we will be out of cash.
All right. Okay. Next is share exchange. This is usually the most commonly used. The bidding company does not have to raise cash to make the payment. That's the first advantage. Second is you can bootstrap. That means you can just use their price. There is one option, earning based method. If we use their P, we can just artificially increase the value of the business. Next is shareholder capital is increased. Overall, the capital in the business will increase. That's the famous advantage if you do share for share exchange. As we just gave the example also. Ours is $10, and if there is $5, we can just give 1 share of ours compared to 2 shares of them. And sometimes we have to give some premium also. Disadvantage can be the bidding company shareholders have to share future gains with the acquired entity. So maybe DAISTRUK shareholders are not happy to have new owners coming in from outside. Maybe their point of view, their understanding is totally different. Let's say we have shareholders who are totally depend on this and they want higher dividend. But we got a new set of shareholders who are just looking for future. They are working professionals. They want more money for their retirement. They are not worried about the immediate dividends. Definitely there can be a conflict, and it will be difficult for us to decide the dividend policy. Next is price risk. There is a risk that the market price of the bidding company's share will fall during the bidding process, which may result in the bid falling. Now, if you are acquiring a company, sometime if the company we are acquiring is not that big, so our share price, let's say if it is 10 now, it can come back to 9. And if it is come back to 9 and you'll say that you'll pay 1 share for 2 shares you're holding, then they will say 2 shares of ours is costing 10 and you're giving us $9. they won't be happy. There's also a price risk because we are into semi-strong market. Right? What else can be advantage and disadvantage? Hello? Just quickly, last 5 minutes, we'll finish. Hello, am I audible?
Yes, yes, you are.
So the biggest advantage here is nobody is paying tax here. And it's very safe for us also and for them also. Why safe for us? We don't have to worry about raising finance. We don't have to worry about our gearing. In fact, our gearing will improve with this. And for them, they don't have to give away the ownership, right? And usually they will get a premium. If it is 5.5, maybe we'll give them at 1.5 shares, not exactly 2. And plus they are retaining the ownership. Yeah. Anything else?
I guess this doesn't work if it's a hostile takeover.
This can work in hostile also, no problem.
Okay.
Hostile takeover for us is more about board, not the shareholders. Shareholders are happy.
Okay.
It's not like everybody is against it. It's like majority is in favor only. But the board who understand it better, they are against it.
Okay, I understand.
Quickly, any disadvantage? Yeah. Okay, one disadvantage is price risk. When the share price will fall down. Already DAISTRUK share price is falling down. It will take a lot of time or it will be very difficult to increase the share price again, which can affect our other covenants we have with the banks and other commitments with the stakeholders.
Misbah, what happens if you're acquiring a firm which is not so strong as DAISTRUK, but we are gaining from that acquisition, right? So the offer price will be 1:2 or whatever. But then as a company, we might gain from their competitive advantage of the other firm, but that company may or may not be strong enough to operate. So their P ratio or probably their EPS, in turn, their share price is not as strong as ours. So on the one side, valuation is a liquidity factor to go for it, but share price not.
Yes. So whatever their current valuation is, we have to pay them a premium. Then we have to acquire it. And after acquiring, we have to see after the premium, what synergy we are getting, what is our benefit.
And realizing that synergy, but usually takes time, you know that, right? Even if you realize that synergy from that combination will require a lot of change management in the first place. Then second thing is realizing that synergy would take at least a year down the line, maybe bare minimum, or maybe earlier. But then this has a direct impact on my share prices because come what may, people will be skeptical that what this acquisition will look like, right, for them. And there's a lot of speculation in the market in that way. So even if the share-to-share option is there, there's a high chances that my price will go down.
Yes. So we have to be, that's the downside of going with share for share exchange. But usually if the company is very big, this is the only option or is the most used option for that.
Yeah.
You have to find a way somehow to maintain that share price.
For us, this is the only option.
Yes.
We don't have cash. Not at all.
Maybe we can raise. We cannot say only option. We can raise and buy off other companies through debt or rights issue.
Yeah, but another option would be that your borrowings could be one, because we are sitting at almost like 39-40% of our gearing, right? Usually 50% plus could be easily to go with, right? So even if we increase our borrowings, definitely it has a finance cost, but it will not impact much. So this is one option, but then we'll have to look at other consideration, including the borrowings, if not go with equity.
Right.
Because we are currently at 39.5, we still can go till 50. And 50-50 is a safe option to go with, irrespective. If we take share for share exchange, it will lower down the gearing.
Right.
Yes, it's always like a blend of different sources, because the entity that we are taking over will also not accept 100% equities. They will also need some cash, so that it will be a successful takeover. So I think it's always, as Vishal said, we need to find a middle way to acquire any company by giving some cash, some equities, and then look out for some outside finance. Yes.
And Misbah, what if the new company will have a, for example, 30%, 40% dividend payout? We are at 83%. The other company is at 40%. Now, if we have to drive down the synergy, not in the operations, but also across the financials, even if we adopt it, one way to look at it is that acquiring company and the acquirer both will face the consequence, because either way, we cannot go with the 40% of a payout, plus we can't even go with the 83% of a payout.
Right. So usually when we acquire some companies, their existence is gone. Whatever their gearing and their dividend, everything doesn't matter. Unless it's a very big company, then we might have to consider that in dividend policy. When there are minority shareholders, we don't have to worry much about it. If
So
the
you mean
shareholders
that
are not happy, like you said, some shareholders are not happy from there, they can just sell it off. No problem. Marketable shares. Yeah.
Okay.
The last one is yeah.
Sorry. Yeah.
Tell me.
No, I mean, I was just touching the point of dividend paying. So I was just reading yesterday for the dividend payouts by the HDFC Bank, which is the largest bank in India. So I saw it was giving a decent amount of dividend in initial years, but suddenly in few years, 3 to 4 years down the line, when there was some integration was happening, HDFC Bank directly stopped paying the dividend, and it was, I think, 0% dividend that they paid for consecutive 3 years. So I think that could be a bold decision, being as a banker. So that also something sometimes the companies can decide, if we are going ahead with the investment, the huge investment. Of course, we have to get rid of some sort of dividend, or we need to reduce our dividend payout.
Right. So this we have discussed in E3 also a little bit. We cannot just keep all the shareholders happy at the same time.
Exactly.
We have to prioritize. So if we just gain the confidence of the shareholders that in the long term we are planning for something good, so they have to compromise for the short term gains or adjust for that. And sometimes we just have to prioritize other stakeholders also. Only dividend for shareholders will not make us survive in the market. Okay, the last one is earnout, where usually the owners or sometimes the management is kept with us. They get some small amount of money, but other money is they will get once we have achieved the synergy. Usually it is done when you are just acquiring company for the management or the key professionals. The arrangement gives a measure of security to new owners who pass some of the financial risk associated with the purchase of a new entity to the seller. This is just to lock up the key players. Will not pay the entire amount, because what if they resign once we acquire the company? Then there is no point of achieving the synergy. This type of is very rarely accepted by the target company. Reason is this work best when we are just doing for the specific business, specific plan, and for a specific project kind of thing. Okay. And another problem for this is the acquire. Let's say DAISTRUK will have some ability to block the unknown targets. They will purposely not support for them to achieve the target. So that will also give some confidence challenge. They will not have enough confidence in the company to go with the earn-out option. All right. So this is the third option we have. Then evaluating share for share exchange is just about the valuation of the company. Okay, then last thing we have is Durkers has come up with some integration process. So this guy has given some 5 golden rules for any acquisition or mergers, which can help in integration. So the first one is within one year, we should give the top management to the target company to help them grow. Second is we should not always think what we are getting for us, but think for others also, what we can offer them. Third one is we should respect their cultures, their product, their customer, their way of working. Fourth one is once the acquisition or merger is done, we all should work as a common core of unity, basically one organization. There should not be bias against each others. Last one is within 1 year, there should be so much of cross entity promotions or transfer that we all become one. Their managers can come and do in DAISTRUK, people can go and work with them. Basically, there won't be any other organization, but the team should collaborate with each other. Again, you don't need to remember these points. You can just add your own points for integration process, any logical points. And the last thing is the due diligence. So there are certain points given here. What due diligence or what key points can help us to make it effective? The best plan is we should have the plan ready before the acquisition itself. The best strategy. Second is the synergies. Everything should be planned before only the cost cutting. What are the ways of synergy? Third is the difficult part. The redundancies should be planned in advance again. Excuse me. Last one is risk diversification. What are the new risks we'll be facing? Next is the cost of capital should be reevaluated. Sometime it can go up. Last one is how to improve the communication. Communication is very important, especially in the first 1 year. Last one is how to achieve the economies of scale what we have planned. Then we can take care of the assets what they have. Then sometimes, especially if you are doing horizontal acquisition, you have to be more aggressive in marketing. Then risk of the acquisition need to be evaluated. What risk we are taking, what new risk. And last one is both of them should work in common core, harmonization. Their objective should be same. These are some of the points we have to be careful when we are determining our mergers and acquisition strategy. These are the common points. That's it from this. Any questions on the last one? The important part from this chapter is the 3 ways you can do the deal: cash, share for share, and earn out. And depending on the question and the attached material, the scenario, you have to recommend one of them, and you might have to give the advantage and disadvantage of each one of them. And these are some logical points which you have to be careful before planning the strategy. In one line, we can just say we have to be more proactive than reactive when planning. That's it. Okay.
Okay.
I know we have done a lot of things today. Please revise it. I'm very sure it will make sense to you completely. Okay. If there is anything, we can discuss again.